All right, we have news on Canada's economy, which seems to have stalled in February amid tariff threats. Now, the GDP data that just crossed gave us a January reading, but it also gives us an early peek at February. Let's try to walk you through all the data that Stats Canada is providing right now, but the market might key more into the early February read than the January read. So, starting with the story of January, we did see a robust expansion, 0.4%. That is the strongest monthly pace for GDP since April last year. That beat the average expectations among Bay Street estimates. Last I checked, there was an expectation month over month you might see a 0.3% increase. And remember, coming into this year, some economists were suggesting that Canada's economy had a bit of momentum, in part because of all the interest rate cuts. That being said, it does appear as if some of the early February readings are suggesting that growth overall came to a halt in February, according to the initial estimates from Stats Canada. So the advanced data shows GDP was unchanged during the month, and that's obviously going to raise the flag on what do we do from here? How does the Bank of Canada respond to that? Remember, the Bank of Canada Governor Tiff Macklem said last week that the risk of higher inflation from a trade war limits the bank's ability to cut interest rates to boost growth. So we've got to have that consideration as well. We do have another Bank of Canada interest rate decision on April 16th. So there is a bit of time to absorb what happens next week in the trade fight with the United States, what happens on that so-called Liberation Day. As I'm looking through some of the data on February as well, it looks like growth in the manufacturing and finance sectors was offset by some declines in real estate, in oil and gas extraction, in retail trade. And remember, last week, we did see some preliminary data for February showing consumers in Canada were paring back spending for a second straight month. And I guess the other consideration here when you're looking at January and February is, was any business pushed up in the face of some of this uncertainty around tariffs? Looking at the Canadian dollar at this hour, we are seeing some weakness there. It was already weak against the U.S. currency heading into this report. I do want to just very quickly add, though, simultaneously, we're getting some news on the U.S. economy, and the U.S. Federal Reserve's preferred inflation metric rose at a stubborn pace in February. Household demand was weaker than expected, and that could illustrate a more guarded consumer and growing concerns about their finances in the U.S. as well. So there's a bit of a balancing impact. It almost makes you feel like there's economic worries on both sides of the border. Okay, let's get some instant reaction to all of this. Carl Gomez is joining us. He's chief economist at CoStar Group, and still with us at this hour, Andrew Pyle of CIBC Wood Gundy. Carl, let's start with you. What are the takeaways here for you on what it says about where Canada's economy is as we gear up for this trade fight?
Well, I think, as you mentioned, going into 2025, the Canadian economy had started to improve. Preliminary estimates of January monthly GDP suggested that was the case, and we certainly saw that number was slightly higher than consensus expected. You made the point about maybe, a lot of businesses getting, prepared for a trade war. And I think that it was showing through in the data in January. We saw a notable uptick in trade activity, exports and imports. I believe there was a little bit of inventory stockpiling that might have been going on at that point. And so that kind of reflected in the data. I'm not surprised that February showed, flattish sort of growth, a little bit of weakness. I've been trying to look at some leading indicators of growth to kind of give a handle on what the sentiment and pulses of the economy going into a trade war. And one of the indicators that I was looking at was container traffic. Those containers that go on trains back and forth that kind of, look at the distribution economy. And we saw a noticeable decline in that activity coming into February. I think that's where, the pedal hits the floor is in terms of these tariffs, is that we're going to start to see that start to bleed over in the data. So my takeaway here is one where, okay, we got some January data. that's all rear view looking mirrors. What really is going to, affect the economy now at this state is the impact of those tariffs. And we just are starting to see that on the data. We feel that things are going to start to weaken considerably in the second quarter.
Andrew, I know you wanted to weigh in, and plus I know you've got some questions for Carl as well.
Yeah, Carl. So you mentioned the inventory overhang that we might be looking at right now, just based on stockpiling coming into this year because of the fear of tariffs. The Bank of Canada, to John's earlier point, has some concern about the inflationary impacts of tariffs. But in your opinion, if we have this inventory build, is there now the potential for disinflation if we have weaker demand for businesses now to get rid of product and cut prices? Is that an offsetting factor, in your opinion, against what we're going to see inflationary on the tariff side?
Well, I think it's a great question, and I do think there was some disinflationary pressure in the Canadian economy already to some extent. If you looked at consumer price inflation and you took out some of the hotter sectors like shelter, which were, in my mind, a little bit of backward-looking sort of lagging indicators, we'd already tripped below, to some extent, below the Bank of Canada's 1% to 3% target range, and that was a reflection of some of the excess slack that was building in the economy. But I think the overarching theme here is really the tariffs. When you get 25% tariffs on manufactured goods, and that's stackable on top of things in the auto sector, you add in the metals and everything else, those costs are going to be passed through to consumers on both sides of the border. And so I think the inflation figures are going to, really get pushed on that end by the tariffs and trump the impact on the disinflationary slack sort of buildup. Bank of Canada already kind of noted that, and that they're going to be mindful and guarded on the inflation numbers. And, even when we saw the last set of indicators for inflation in the previous month, we did see some underlying hotness there in some categories. Inflation is not going away. We believe inflation is actually going to be a bit more of a problem as we go through this. One indicator that I looked at, too, is the University of Michigan inflation sentiment indicator in the U.S., and what was interesting is 5-year expectations of inflation shot up dramatically in March in the U.S. So I think there's this anticipation that inflation is happening. And more troubling to that for central banks on both sides of the border is inflation expectations are now starting to heat up. So regardless of the slack that's building up in the economy, those expectations are now anticipating, higher prices.
Carl, on that note, I'm going to ask our control room if we can take a live look at what's happening with the U.S. equity futures as the market digests all this data on both sides of the border. And basically, there has been some softness in the pre-market today. Sure, they're keeping tabs on Canada, but this is really more of a U.S. story where, to your point, you've got continued signs of sticky inflation stateside, and then indications that household demand is weakening. And then you add to that for Canada the story of a stall starting in light of the trade uncertainty for Canada's economy. How much attention are you increasingly going to place on government officials and potential fiscal supports as much as you're going to be looking for any guidance from central bankers on how they're navigating this kind of stuff?
Yeah, it's going to be interesting on the policy response, because I think we do get an indication. Tiff Macklem, our chief banker in Canada, basically indicated that there's only so much monetary policy can do in this environment because they're in a bit of a bind. They have to balance the growth risk with those inflation risks. We did a little bit of a look back at different emergencies in the Bank of Canada back in the GFC, back during COVID, even during a little bit of the oil crisis in 2015, 2016, came to the rescue by lowering interest rates down to zero. We think there's going to be a floor on the Bank of Canada this time around because of those inflation risks building up on both sides of the border and globally, I imagine, as well as supply chains get rattled. So the Bank of Canada can't do everything on this one. We can't rely on the Bank of Canada to lower interest rates, unleash animal spirits, have the real estate market take off based on, extremely low, all-time low emergency rate cuts. So we're going to have to lean on some federal spending, some fiscal response. I think the fiscal response, hopefully different than COVID, is not one where we just throw money at the solution. I mean, certainly for auto workers and a number of employees, giving some support there because we are anticipating some significant job losses. So some fiscal support on that end. But I think the fiscal support, hopefully, I mean, we don't know because we don't have a government yet that has got a mandate, but hopefully the fiscal support also entails supporting productivity growth, supporting businesses in a way that they continue to invest. And so that may require a very different response than just basically throwing money out, as we did in the fourth quarter with what was perceived to be a vibe session.
Andrew, any final thoughts from you?
Yeah, just on that point, Carl. So when we look at fiscal latitude here, Canada and Europe probably have a little bit more latitude in a protracted trade war than the States, where we're still looking at trillions of dollars in tax cuts. Would you agree that the U.S. ironically is a little bit more limited in reaction to a recession if that's what we get?
101%. I mean, the fiscal capacity of the United States was already in a bit of trouble coming out of COVID. The taps didn't turn off after that. Interestingly enough, the mandate that Trump was elected on was basically to say, I'm going to, work on that debt by getting tariff income coming in and cutting taxes. I don't see the fiscal response being all that much to save both economies, both in Canada and the United States. And when Germany actually turned on the fiscal taps, what we saw was a significant bond market reaction. That is my concern, is that the bond markets and the bond market vigilantes are getting concerned about those fiscal bloats. And, we're turning a term premium back on fixed income, which means that I think interest rates on the longer end of the curve may be pushed up and buoyed up in this environment, given that fiscal bloat, given that inflation risk.
Okay. Carl, appreciate that breakdown. Carl Gomez joining us, chief economist at CoStar Group. Andrew Pyle of CIBC Wood Gundy also weighing in, and Andrew's going to be staying